welcome to Economic Insights. I'm Alex, and with me is Selim, market veteran and producer of this show. Selim, I feel like we're navigating through fog this week with all this missing data.
That's a generous way to put it, Alex. We're not navigating through fog. We're driving a car with a blindfold on while the GPS argues with itself about which direction to go. The Fed is supposed to make rate decisions in December without knowing what happened to employment in October or November. It's absolutely spectacular incompetence.
Wow, tell us how you really feel. Let's get into what made this week so chaotic. So let's start with what everyone was watching, Nvidia's earnings. The anticipation was intense, wasn't it?
Intense is putting it mildly. The entire AI narrative was on trial. Markets sold off for 4 consecutive sessions leading up to Wednesday night. The S&P 500 hadn't been below its 50-day moving average for 139 sessions. That's a long stretch of complacency coming to an abrupt end. The VIX hit 24.7. Credit default swaps on AI companies were widening, and even positive news couldn't catch a bid.
What positive news got ignored?
Microsoft and Nvidia announced an investment in Anthropic. Normally, that's the kind of thing that sends tech stocks soaring. The market's response? A collective yawn. That told you everything about sentiment. Investors may have been waking up to the fact they'd been paying silly prices for a story that might not pan out,
Then Nvidia reported Wednesday night.
and delivered a solid beat on revenue with strong guidance. Asian markets exploded higher Thursday morning. US futures gapped up, and at one point the S&P was up almost 2% intraday. That's when things got truly bizarre.
It didn't hold, did it?
Not even close. By the closing bell, the S&P was down 1.5%. That intraday reversal was the biggest swing since the market turmoil in early April. The relief rally lasted about as long as a politician's promise.
Why did it reverse so violently?
Because one earnings report doesn't resolve the existential question about AI profitability, Alex. And you had the Fed policy confusion creating a second layer of uncertainty. Markets hate uncertainty, and we had it in stereo. By Friday, things calmed down. Nvidia recovered most of its losses, Walmart's strong earnings helped, and investors caught their breath. But the whiplash was real.
Let's talk about that Fed confusion because that seemed to dominate the narrative.
Here's where the government shutdown from earlier this year really comes back to haunt us. The Labor Department cancelled the October jobs report entirely and delayed the November report until December 16th. The Fed meets December 10th. So they're making monetary policy decisions without 2 months of current employment data. It's like asking a surgeon to operate in the dark.
That's problematic.
Problematic? It's farcical. Early in the week, hawkish Fed commentary pushed the odds of a December cut down to 41%. Then the FOMC minutes from October came out midweek, showing many officials were against a December cut. When that hit the tape along with the delayed data announcement, the probability of a cut collapsed from 47% to 27%.
But we did get an employment data, albeit delayed.
Yes, the September report finally emerged from the backlog. Payrolls came in at 119,000 versus 51,000 expected. Sounds good. But the unemployment rate jumped to 4.44%, the highest in nearly 4 years, nearly rounded up to 4.5%. It's the perfect ambiguous data set. Hawks look at the headline beat and say, the labor market is fine. Doves look at the rising unemployment and negative revisions and say we need insurance cuts. The odds of a December cut ticked back up, but that's still basically a coin flip.
And meanwhile, crypto was falling off a cliff.
Bitcoin dropped to below $85,000, a 7 month low, heading for its worst month since June 2022. When crypto sells off that aggressively, you have to worry about contagion. Leveraged retail investors facing margin calls don't just sell crypto, they liquidate whatever they can. That's how local problems become systemic.
Despite all this market drama, the underlying US economy seems to be holding up. Is that accurate?
That's the irony, Alex. The real economy data looks reasonably solid. Aggregate private payroll income is growing at 4.4% annualized. That supports consumer spending nicely. GDP tracking for Q3 is at 2.9%, and Q4 is tracking even stronger at 3.1%. November PMIs showed services at 54.8 and manufacturing at 52.5, both comfortably in expansion.
So why are markets so jittery if the fundamentals are decent?
Because markets don't care about yesterday's data, they care about tomorrow's Fed policy. Good economic news means the Fed has less urgency to cut rates, which disappoints investors who've been pricing in aggressive easing. Plus, those tariffs are starting to bite. The effective tariff rate is now 14.4%, and we're seeing it show up in core goods prices. That gives the Fed another reason to pause.
What about the bond market?
Credit spreads have been widening. Investment grade hit the widest levels since June. High yield spreads moved up too, though they recovered somewhat by Friday. Amazon tapped the market for $15 billion, which shows there's still appetite for quality paper, but investors want to be compensated. Oracle's credit default swap was very much a conversation topic this week. It is almost a proxy for AI related text credit worthiness.
Across the Atlantic, what's happening in Europe?
Euro positioning is at its most bearish level since February, so everyone's already leaning against it. Growth data is actually improving, but the ECB has only priced in 9 basis points of cuts by June. That's nothing. If negotiated wages continue decelerating below 2%, which is what we saw in Q3, there's downside risk to their services inflation forecast.
And the UK?
The big event is the autumn budget on Wednesday. Markets are expecting about £35 billion in fiscal consolidation, a contractionary shift that should pave the way for softer data and more Bank of England easing. The gilt market has already priced in concerns about significant issuance, so the fiscal sustainability worries are baked in. Sterling should face headwinds from this.
Italy, your favorite? Got some good news this week, didn't it?
First time in 23 years they've been upgraded by Moody's by a notch. That's legitimately positive and reflects years of relatively responsible fiscal management. In a week dominated by bad news, Italy proving the skeptics wrong is worth noting.
And then there's Japan with their massive stimulus package.
21.3 trillion yen, Alex, largest since the pandemic. Their Q3 GDP contracted 1.8% annualized because exports collapsed, so they're pulling out the big guns. Here's what's fascinating. Long end JGB yields are rising to multi-year highs. 10-year and 30-year term premia have broken above their April highs. The market is basically saying, if you're going to spend this much, the BOJ will have to normalize rates faster.
Are they worried about a UK-style bond market crisis?
Markets are definitely watching for a truss and lettuce moment, a sharp concurrent decline in bonds and currency.
Ha 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 ha. You love the lettuce, don't you?
Priceless. Japan has some stabilizers. Current account surplus, massive net international investment position, no pension leverage blowing up. But the JGB market is fragile. Life insurers aren't buying super long bonds anymore due to demographics and regulations. You're relying on pension rebalancing flows and foreigners. That's not exactly a solid foundation.
And the yen?
Dollar yen surged from 147 to 157 in 7 weeks after Takaichi became PM. Japanese officials are using the classic intervention language, rapid one-sided moves, which means they're getting nervous. Past interventions have knocked about 3 yen off the exchange rate, but sustaining it requires actual policy changes, not just jawboning.
What's the broader dollar picture?
Dollar strengthened despite disjointed market moves. It's being driven by positioning unwinds, negative risk sentiment, and reactions to foreign fiscal developments, especially that massive Japanese package. The strength is justified in the near term, but probably not durable. The main downside risk is if unemployment keeps rising, which would keep pricing in for a December Fed cut.
Any currencies looking attractive against the dollar?
Analysts are recommending longs in Aussie, Canadian dollar, and sterling against the greenback. But with the UK budget looming and fiscal tightening expected, sterling has its own headwinds to deal with.
Let's turn to emerging markets. South Africa cut rates this week, didn't they?
Indeed, the SARB delivered a unanimous 25 basis point cut, bringing the repo rate to 6.75%. The statement was scored as highly dovish. They're acknowledging growth concerns and their new 3% inflation target with a plus or minus 1% tolerance band gives them more room to ease. But here's what's interesting. They explicitly modeled two scenarios that could slow future cuts. First, if the dollar rebounds strongly and pushes dollar rand near 19 instead of the baseline 17, they could leave rates 60 basis points higher temporarily. Second, if administered prices like electricity tariffs spike, that elevates inflation expectations and limits their room to cut.
They also mentioned something about AI bubbles.
Yes, they actually referenced global financial market vulnerability and signs of a bubble inflating in AI valuations. They're worried about negative spillovers to emerging markets if that unwinds. Their policy stance is dovish. They're forecasting a terminal rate of 6% by 2027, with two cuts in 2026. But it's all contingent on growth improving.
What about Egypt? And didn't they have a central bank meeting too?
They did, and they held rates steady. This wasn't a surprise given that inflation has been accelerating. Headline hit 12.5% from 11.7%, core reached 12.1%. They're in wait and see mode after that fuel price hike in mid October. They want to see the full pass through before cutting again.
Turkey? Anything interesting there?
Portfolio investment in Turkey has been disturbingly low. When you're an emerging market, you need those capital flows, and Turkey just isn't attracting them despite keeping rates elevated. It's a credibility problem. Investors remember the unconventional policy years, and they're not convinced the orthodoxy will stick.
China continues to slow?
The macro data shows a continued slowdown into late 2025. Auto sales and new home sales are declining significantly. But here's the paradox: they still posted 5.2% GDP growth in the first three quarters, which reduces the likelihood of a year end rate cut. They need to accelerate fiscal and quasi fiscal easing instead of cutting rates. The yuan is getting support from year end seasonality, and the PBOC maintaining a stronger bias. Foreign investors reduced bond holdings for the sixth consecutive month in October, which tells you something about confidence levels.
India had some dramatic trade data this week.
Record high trade deficit of $41.7 billion in October. Gold and silver imports surged to an 11-month high, and goods exports contracted 11.8% year over year. The services surplus hit an all-time high around 20 billion, which partially offsets it, but that goods deficit is eye-watering. The rupee is holding the biggest long position in Asian FX. Traders are expecting it to trade in the 88 to 90 range versus the dollar.
Are they going to cut rates?
Markets anticipating a 25 basis point repo rate cut in December. Headline CPI inflation is forecast to moderate substantially to 2% year over year in the fiscal year. They're in a decent position to ease. The long-term outlook is very bullish, projecting India becomes a $7 trillion economy by 2030. But near term, trade talks with the US have stalled, which creates some currency downside risk.
Korea seems to be in a tough spot with their currency.
The won has weakened substantially, large outflows from pension funds and retail investors. FX authorities have pledged market stabilization. The Bank of Korea meets Thursday, and there's a debate about whether they cut 25 basis points or hold. GDP growth forecasts have been revised up thanks to semiconductor and AI chip exports, but CPI inflation forecasts are also rising, and Seoul housing prices are accelerating. That complicates their decision.
But they have something positive coming next year, right?
Yes, South Korea gets included in the World Government Bond Index in April 2026. That's expected to draw $55 to $60 billion in inflows, predominantly benefiting the long end of the curve. That's a massive positive for their bond market and should provide structural support.
Hungary had some drama this week.
The National Bank of Hungary held rates, maintaining their hawkish bias and preference for a strong forint. But then, Deputy Governor Barnabas Virag resigned. His 6-year mandate got curtailed. The forint had its largest decline in over 6 weeks on that news. Markets are jittery about anything that might undermine the assumption of stable rates. Hawkish direction under Governor Varga should remain unchanged, but markets don't like uncertainty about central bank personnel, especially going into the critical elections next April.
And Poland?
Poland is actually looking good. November headline CPI is expected to slow to 2.6% year over year, the lowest in 17 months. Base effects are favorable. Durable goods, inflation is contained. That's setting up for a 25 basis point cut at the December meeting, bringing the policy rate to 4%. But they're close to the end of their easing cycle. Growth is strong, fiscal risks are increasing, and inflation is projected to accelerate toward 3.5% in the second half of 2026. They might get one more cut in March, terminal rate around 3.75%, and then they're done.
What's on the calendar for next week?
Tuesday and Wednesday are critical before the US market closes for Thanksgiving. September retail sales comes Tuesday, expecting about 0.4% growth after strong summer readings. That'll tell us if the consumer is taking a breather or maintaining momentum.
And the inflation data?
September PPI also comes Tuesday. This is absolutely crucial because it's the last inflation input the Fed will have before their December 10th meeting. Without October CPI or proper November data, they're relying on stale information. Forecast is for core PPI to rise 0.2%, keeping the year-over-year rate around 2.9%. If it comes in hotter, it gives ammunition to the hawks. If it's cooler, the doves get their argument.
What else should listeners watch?
Wednesday brings durable goods orders and initial jobless claims. Claims will be important because it corresponds to the November survey week. The Fed will be leaning heavily on weekly claims since they won't have proper payrolls data. Conference Board Consumer Confidence Tuesday and the Fed's Beige Book Wednesday round out the data.
Central bank decisions?
Wednesday, Reserve Bank of New Zealand will almost certainly cut 25 basis points with unemployment at 9-year highs. Clear spare capacity. Bank of Korea on Thursday is the interesting one. Markets are split on whether they cut or hold given the won's volatility.
The UK budget is the big event, though.
Wednesday is budget day, expecting £35 billion in fiscal consolidation. Markets will be watching gilt issuance plans very carefully. Any surprises there could cause volatility. It's a contractionary shift that should eventually lead to softer data and more Bank of England easing, but the initial reaction could be messy.
Anything else?
European CPI data Friday. Germany's numbers should jump to 2.8% year over year due to base effects. Poland's CPI data is also due next week, which will confirm whether they're on track for that December cut.
All right, Selim, another wild week ahead. Thanks for walking us through it all.
Always a pleasure, Alex. Let's hope the Fed figures out how to make policy without data. Should be entertaining.
Indeed. Don't forget, folks, we do not give investment advice. For that, please consult a professional. We'll see you next week on Economic Insights.